We've covered a lot of ground in this course, haven't we? You know a lot more about stocks and the stock market than you did before. It's time to take a closer look at your financial situation and decide what to do. Pull up a chair, sharpen your pencil, or open your spreadsheet. Analyze your current financial position. Where are you now? Start by listing your assets and liabilities. Lots of people think they don't have any assets. They think the only things that count as assets are stocks and investment property. That's just wrong. Your bank account is an asset. If you own your own home, then be sure to list it and try to get its current value. Don't use the purchase price if you can help it. We'll handle any mortgage in a minute. List your bank CDs, the savings bonds you got from grandma when you were a kid, your 401k at work, and your credit union account. Find them and anything else you own and list them as assets. After you've listed your assets, check your liabilities. Those are the things you owe. Count the remaining principal of your loans. Here's where you include your mortgage, your car loan, and any other recurring fixed payments. Not credit cards, they come later. The value of your loans isn't the monthly payment because you're going to be making a lot of payments before these loans are paid off. The easiest way to get the remaining principal is to ask the lender. He'll know. Now, list your outstanding credit card balance, even if you're not rolling over anything from month to month. List any other bills you haven't paid yet, like property taxes. Look over your old credit card bill and checking account statements to see if you've forgotten anything. Now you know what you own and what you owe. Next, you need to know how much income you have and how large your outflows are. Income is relatively easy. List your salary, interest income from those assets you listed earlier, alimony, assuming you're on the receiving side, rent you receive, so forth. Expenses are harder. Your money comes in from just a few places. It goes out to lots and lots of places. Credit card statements and bank statements are the place to find your expenses. When I look at those statements, I'm just about done because I almost never use cash anymore. If you use cash a lot, then you might need to keep track of your cash spending for a couple of weeks. You might be surprised where your money goes. Once you learn, though, it's much easier to reduce unnecessary expenses. Another reason that estimating expenses is harder is because some outflows are lumpy. The poster child for this is your car. I like to buy a fairly nice car and then run it until I see signs that the wheels are about to fall off. These days, that's more than a decade, and I haven't bought a car for a few years. If I look over my recent expenses, I'm not going to see an entry for buying a new car. It'd be easy to forget to list that upcoming expense. An easy way to handle that is just to take your best guesses on when you plan to buy your next car and how much you plan to spend. Then just divide your guess on the price by your guess on the number of months until you think you'll need it. That's about how much you need to budget each month, so count that as a monthly expense. Once you have your inflows and outflows, then you'll be able to estimate your monthly savings. Unless you have a big pile of assets compared to your liabilities, if more money is going out than coming in, then you need to fix that before you think about investing in stocks. Your choices are either to spend less or to earn more. That's it. I'm afraid there is no third choice. Let's assume that you're in better shape than that, and that most months you have a surplus that you can invest. The next step is to set your financial goals. Some of these will prove to be unrealistic, and you'll need to revise them after the next step, which is to get a feel for how to reach your financial goals. Let's keep this example simple and say that you only have one goal, and that's to retire in 30 years with $500,000 more than you would if you keep doing what you're doing now. 30 years is 360 months, so if you earn nothing on your investments, you'll need to save $500,000 divided by 360 months, or $1,389 each month. That's a tall order for most people. You'd better earn more than nothing if you're going to make this happen. Fortunately, you have 30 years to accumulate your goal of $500,000, and we know that time is a powerful ally when we save. Applying the formula for calculating annuities that I mentioned in Lecture 6, we can figure out that you need to save a little less than $500 each month if you can earn 6% annually after taxes. That $500 might still seem to be out of reach, but it's a lot easier to save $500 a month than $1,389, and you can reasonably expect to earn 6% after taxes if you invest in stocks. No promises, of course. If you can manage to find that $500 each month, then you probably don't need to do anything dramatic to reach your goal. You may not even need to invest the entire $500 in stocks, because many experts will tell you that expecting a 6% after-tax return on stocks is on the conservative side. If you can't manage to save $500 a month on your current income, then something has to give. We learned how important taxes are in Lecture 14. Do you think that you can reduce your taxes so that you can earn 8% after taxes instead of 6%? If so, then you can reach your goal by investing just over $335 a month. Better yet, if you can put your investment into a Roth account, then you'll earn tax-free income, and a 10% expected return is reasonable based on historical averages. Again, no guarantees. An annual return of 10% would lower your monthly savings requirement to just over $220. Counting on earning more than 10% after taxes annually without taking even more risk than the stock market offers strikes me as overly optimistic. Oh, it could happen, but I wouldn't count on it. That means that if you can't make these numbers work, then you're probably going to have to make a lifestyle change, like getting a second job, or planning to work an extra couple of years, or reconciling yourself to making do with a smaller nest egg. Better to learn that now than to be surprised later. In our example, we should be glad that we have 30 years to accumulate our nest egg. Remember way back in Lecture 1 when we said that saving and investing is like planting a tree or dieting or exercising? We said that although the best day to start was 15 years ago, the second best day is today. You can still do yourself a lot of good by acting now. Deciding to invest in stocks is part of a larger investment decision called asset allocation. Choosing your asset allocation means deciding what proportion of your wealth you want to invest in stocks, bonds, real estate, and safe assets like treasury bills. One famous study of 82 pension funds found that over 90% of the variability of returns traced to the fund's asset allocation. That leaves less than 10% that depends on the specific stocks and bonds the fund held. Do you know why? The main reason is that stock returns are more variable than bond returns and vastly more variable than treasury bill returns. If returns on bonds and bills vary just a little, while stock returns vary a lot, then almost all of the variation depends on how much you have in stocks. The goal of asset allocation is to choose a portfolio that gives you the best combination of risk and expected return for your particular financial needs. If you play it too safely, then you might not have enough money to retire when you want, even if things go well. But if you take too much risk, then if things go wrong, you might need to take a second job just to get by. Retirement might become an impossible dream. A good part of asset allocation is diversification. True, you can diversify your portfolio of stocks and eliminate as much as 70% of the risk you'd take if you held just one stock. Still, that leaves 30% of the risk, the market risk, that you can't eliminate. If you hold stocks, then you'll hold market risk. That's one reason why you might want to hold some bonds. They tend to be safer than stocks, and their value doesn't move in lockstep with the market. If your stock portfolio goes down, then maybe your bond portfolio will gain to offset that loss. The same holds true for real estate. The value of housing doesn't move in lockstep with stocks or bonds, and that makes it attractive. Some of us, though, have more than enough of our wealth invested in real estate already. If you own your home, then you have a big chunk of money in real estate right there, and it doesn't matter if you have a mortgage. Your $200,000 home declining 10% means you've dropped $20,000. I don't have to tell those of you in San Francisco or New York City about the amount of money you need to tie up in a house. A 10% drop in an average home in a place like that can wipe out a year's pay for some people. No, most of us don't need to invest in real estate beyond our own house. We already have plenty. You can find tools to help you with your asset allocation decision on the web. Search for Asset Allocation Calculator or Portfolio Allocation Tools or something along those lines. Most of them will ask you for your age, how much you have to invest, and for some measure of your risk tolerance. Some will ask for your tax rate and how much you plan to save each year. Always use a little common sense when visiting a new website, of course. There's no reason for your Social Security number to affect your allocation, is there? If a site asks for that, then I'd go somewhere else. I'll bet you'll be surprised at how much of your wealth these tools suggest that you invest in stocks. I experimented with a couple of these allocation tools, and the recommended allocation to stocks averaged about 50%. I wasn't holding anywhere near that much in stocks. Guess what? I'm still not. I didn't run out and change my allocation. I know that I'd rather sleep well than eat well. I'm not going to change my asset allocation because of what a black box on the web says I should do. And you shouldn't either. You should still play around with a couple of asset allocators to get a feel for the factors that they use to determine your suggested asset mix. You'll find that the younger you are, the richer you are, and the more you can handle risk, the larger proportion of stocks they recommend you hold. These rules of thumb make sense. For example, if your investments fail, but you're young, then you still have a long time to make up for it. You can get a second job, live a more frugal lifestyle, or even change careers. Those changes can make a big difference over a long time period, but not so much if you're near retirement. I've never seen an asset allocation tool that asks if you're planning to leave most of your assets to your heirs. We saw in Lecture 5 that planning to leave a bequest changes your investment horizon because you're investing for your heirs, not yourself. Your own age is mostly irrelevant in that case. Part of my goal in this course has been to help you become a better informed investor, but a more important part has been to build a framework so that you can look at investing decisions the right way. I hope I've kindled your interest so that you want to learn more. Yes, we've covered a lot of ground, but we've barely scratched the surface of the vast world of investing. One way to learn more about investing is to join an investment club. An investment club is a group of people who get together to share opinions about the stock market. Sometimes they actually make investments collectively too. I like the idea of investment clubs, but not for the reason most other people give. My friend Reggie is a retired postal worker and a great guy, but I don't think he can watch the news, read about Walmart, and then tell me whether I should buy or not. Sharon is a registered nurse who can zero in on people's feelings as well as anyone you'll ever meet, but I don't think she can possibly know more about Macy's than the guys who analyze Macy's for a living. No, I don't think that an investment group can pick winners for me. A group like that can still do a lot to help, though. They can share advice about choosing brokers, for example. They can help me discipline my investing. Think of Alcoholics Anonymous or a good weight management program. In a moment of weakness, these groups give you someone to call for support so that you don't take a step backward. Suppose I hear an analyst on TV say he thinks Macy's earnings might be bad this quarter, and I feel the irresistible urge to deviate from my long-term financial plan and sell. Just like Alcoholics Anonymous, Reggie and Sharon will be there to remind me that even if the analyst is right about an earnings disappointment, it's almost surely too late to do anything about it now. The market has already absorbed the bad news, and the price has already adjusted so that Macy's is probably a fair bet again. Oh, I might still sell, but I'll do it without panicking. We can help each other keep discipline in our investing too. When Sharon starts talking about selling shares because she needs money to get away from the stress of her job for a while, Reggie and I can help her decide to make it a weekend in Las Vegas instead of a whole week in Paris. Don't underestimate the social benefits of an investment club either. People get together with the alumni club to watch Ohio State play Michigan or Tennessee play Florida. They participate in sewing clubs, hiking clubs, book clubs. Why not an investment club? Have some fun and enjoy the confidence of knowing you're not investing alone. Sometimes investment clubs pool their money to make investments. I see pluses and minuses for this. You get all of the advantages of clubs that don't make investments, plus you gain a level of intensity and gravitas that you usually won't find in clubs that don't invest. These clubs can nudge people who have trouble making decisions and taking action. Some people truly intend to invest, but just never get around to it. We know which road is paved with good intentions, don't we? If you decide that a club that actually invests money is for you, then I'd advise you to take it slowly. Visit at least a couple of groups before joining one. That's because by joining, you'll be agreeing to invest in the stocks that the group likes. You may not like some of those choices, but you'll have to live with them. Members of successful clubs share the same general investment philosophy. Successful here doesn't just mean they made money. It also means that members were comfortable with their investments. You also need to understand that if your investment club does the actual investing on your behalf, then the paperwork gets messy. The simplest way to manage investments is for all of us to put the same amount of money into the club and for all of us to share equally in the returns. If you do that, though, then you'll soon see that's far from the best way. How will we handle it when Dottie has a baby and can't participate fully? Will we kick her out? The equal share system can't handle partial withdrawals very well. Eventually, the equal share system will close the club to new members too. That's because the existing members' regular investments will continually build the value of the portfolio. It'll get too expensive for most people to buy an equal share. Most clubs that start out using the equal share system convert to what's called the unit value system eventually. Lots of big investment funds use the unit value system. Remember the net asset value calculation from Lecture 13? That's what happens here. The numbers are just smaller. For example, if our club has 4 members and we all start by investing $5,000, then we can each hold 50 units with each unit worth $100. Changes in the market price of the securities in the portfolio are easy to handle. They rise by 10%, then we each still hold 50 units, but now they're worth $110 apiece. The unit value system makes it easy to change the club's membership. If we decide to admit Kelsey to our club, then she can simply buy units for $110 each. Immediately after she invests, the club will have the same stock portfolio as before, plus $110 in cash for every unit Kelsey bought. The club can decide how to invest the cash at the next meeting. The unit value system is also better if someone wants to increase his or her stake. If you join mostly to get your feet wet and have decided that now it's time to get more involved, then you can do it by investing $110 per new unit. If Dottie's baby makes her cut back her participation, then she can do it by cashing maybe half of her units. The club will either buy her out using uninvested cash or else raise the needed funds by selling part of the portfolio. If you'd like more information on investing clubs and resources for participating in one, they're available on the web. Some organizations offer educational aids, including software that makes it easy for investment clubs to calculate unit values. You can also find active online communities, webinars, and publications, even sample partnership agreements. Now, the bad news. According to Renita Burns, a staff writer at blackenterprise.com, an investment club that actually invests money has to register with federal and state authorities as a business entity. Your club must submit IRS Form SS4 to apply for an employer identification number. You may need to file a Certificate of Conducting Business as Partners form. That's not all. Your club must file a federal tax return, IRS Form 1065. Depending on the state, there may be a state return too. Club members will get IRS Form 1065 Schedule K1 to include their share of the club's assets on their own tax returns. Most people think that it makes more sense to start or join a club that just serves as a forum for education, socializing, research, discipline, hand-holding. Club members can do their own investing on the side. I'm with them. Lots of people disagree, but I say the reporting requirements are way too much work, even if you have a tax advisor to help. Educational and social investment clubs don't have to file that mound of paperwork. I'll find the self-discipline to make my own investments, thank you very much. I'll just enjoy the educational and social benefits. If you've decided that it's time for you to start investing in stocks, or at least almost time, let me summarize some steps to take. First, start now. I don't mean that you have to invest in stocks today. I mean that you need to do something today. Maybe start means look for a brokerage firm that makes you comfortable and open an account. Get a couple of names from friends. Make a phone call or two and ask a bunch of questions, like the ones we covered in Lesson 8. Remember, opening an account is just one step. It doesn't mean you have to invest anything in stocks. Starting small is fine. You can always invest more as time goes on, and even small amounts can grow your investment if you just stay at it. Just make sure that you pick a financial services provider that offers an account that fits your needs. Remember the three variables that determine how much you have at the end of the day? They're your rate of return, how much you invest, and how long you invest. Make those last two work for you. You'll probably want to start small and choose an investment that's been around a while and has plenty of investors already. Remember Lesson 13 and check out a low-cost index fund. The Vanguard Group alone has several with minimum investments as low as $3,000, and just about all of the big firms offer something similar. With an index fund, you'll get diversification on the cheap, and you'll guarantee that you'll earn about what the average investor in stock earns. In fact, you'll beat most of them because most investors will pay more transactions costs than you will. Most financial experts recommend that small and new investors should keep their investment strategy simple. They say you don't need to know everything about an asset before you invest, but if you can't explain it to someone in a couple of sentences, then you probably want to leave that particular investment to the experts. Understanding your investments is good advice, but make sure you understand the advice itself. You really don't need to understand the company in any great detail. The distinction I'm making is between understanding an investment, such as stock, and understanding a specific stock, such as JP Morgan Chase. Before you invest in JP Morgan Chase, you should know that it's a huge financial firm that has operations around the world. Others may disagree, but I think that's probably all small investors like us need to know about the company. Well, that and knowing that millions and millions of people have been buying and selling JP Morgan Chase or its ancestors for decades. What's more important than understanding the details of the company is understanding that owning stock in JP Morgan gives us a claim on what JP Morgan earns after paying interest on its debts and paying taxes. If Morgan makes a lot of money, then we're likely to do well. And if they don't, then we likely won't either. Contrast that with say, oil and gas limited partnerships. I have a general idea about what they are, and I have some vague sense of when they perform well, but that's about it. If someone tries to tell me how great these are, then I'll tell them I leave that one to the experts. I'll leave you with 2 tips I learned that have given new investors peace of mind. First, investing isn't a contest. Your goal isn't to beat your friends and coworkers. Remember, markets are pretty close to fully efficient, and in Lecture 14, we saw that trading is hazardous to your wealth. Just don't try to pick winners so that you keep your transactions costs down. Your savings will be substantial. That will pay for this course, and then some. Lots of people have trouble with this. We live in a competitive society. I know it can be hard to deal with people who tell you about the great stocks they picked. When this happens, remember that their memory isn't perfect, and they may not have done as well as they say they did. They're not likely to tell you about the losers they owned anyway, are they? Just politely congratulate people who say they made a fabulous investment, then smile and get a good night's sleep. Second, never worry about the one that got away. Most of you are too young to remember Gomez Addams of the old TV comedy, The Addams Family. The details of the specific scene have faded with time, but I'll never forget the point. Gomez was horrified to learn that a company, I think it was Consolidated Fuzz, had jumped some enormous amount. "What's wrong?" asked his wife, Morticia. Gomez replied, "I don't own any." Gomez was a silly character, and his investment behavior fit his personality. Look, there are missed opportunities everywhere, every day. You could have made a lot of money betting on the New York Jets against the Baltimore Colts in Super Bowl III, or on the Ohio State Buckeyes against the Miami Hurricanes in college football's national championship game in January 2003. Tomorrow, the stock market will either go up or else it'll go down. Either way, there's money to be made. And unless you have all of your money in the market and make all of the right trades, then you can always have done better. Is that a silly way to think? Absolutely. That's the point. Never worry about the one that got away. I've structured this course around general principles that will still be true in 10, 20, or 50 years. The technology of trading and other details may change, but the major principles underpinning this course will continue to hold. There is no free lunch. If it looks too good to be true, then it probably is. A lot of what you know from other markets, like groceries and car dealerships, is true for stock markets too. You face a trade-off between risk and expected return. It's next to impossible for people like us to pick winners and losers so that we beat the market. Diversification will always be important. 3 things will continue to determine how much you have at the end of your investment: how much you invest, your rate of return, and how long you invest. Minimizing taxes and transactions costs are the easiest way to increase your rate of return. These principles will keep you grounded as you decide whether or not to buy stocks. If you do decide to invest, then do it with confidence. Millions of successful investors once knew a lot less than you do now. What you've learned in this course will allow you to keep learning so you can make better choices. You can do this.